Good evening, everyone. Welcome back to this series of ICAI live lectures for coming CA inter attempt. We have already covered quite a few topics in the subject of financial management, and today's session is going to be the discussion about a new topic that's called as capital structure. Okay, so we are done with the ratio analysis and some other topics also. Ratio analysis was taken up by me, and also the sources of finance. I think cost of capital also might have been done. Right now, we are in the topic of capital structure. Okay, so we are going to have like two sessions on this topic, and those two sessions are going to be dedicated towards two separate set of concepts that we have in capital structure. One concept is going to be around selecting an appropriate plan, and the second concept is going to be around uh, discussing about some debate that is ongoing with regards to the capital structure. Okay. So let's get started with the very first concept of today, in which we are going to talk about the capital structure, funds to be raised. Now, let's take a very simple example to understand as to which is the plan that we are looking at right now. Okay. Now, suppose we are looking for raising funds to be raised. Suppose we want to raise funds to the tune of 10 lakh. We want to raise money to the extent of 10 lakh, and on discussion with all our stakeholders, that is shareholders, debenture holders, preference shareholders, we come across three possible scenarios. So we have finalized like three plans by which we can raise these funds. Let's have a look at what combination of funds we can have for each of these plans. We may have equity, the equity shares with a face value of 10 rupee. We may have debenture, which is going to cost us, let's say, 10%, and preference shares, let's say that's going to cost us 12% in the form of dividend. The first plan that we are talking of to get the money is simply go for, let's say, fully equity funded plan. Okay, so in case of fully equity funded, the entire 10 lakh will be raised by, let's say, equity funds, and no debenture, no preference share. So anyways, 10 lakh is the funds that we need to raise for an investment. Second plan is to raise debt and equity in equal proportion, which will be 5 lakh each. 5 lakh equity and 5 lakh debenture, no preference share. So it's totaling up to 10 lakhs. Then the third plan is to raise maximum amount of funds from the external sources. So equity, let's say we are going to have 2 lakh equity. Debentures are going to be 4 lakh, and preference shareholders are going to be the remaining 4 lakh. So that's totals up to 10 lakh being the funds that we are going to raise. Now, how do we decide which of these plans are going to be useful for us, or which of these plans are going to be the most beneficial combination of debt, equity, and preference share for us? For that, we will definitely know what is the earnings before interest and tax. We'll definitely know what is earnings before interest and tax for all the three plans. So let's say EBIT stands as 3 lakh. Now, it's quite obvious that we can raise money from whatever sources, be it debt, be it equity, be it preference shares, from wherever we are going to raise the funds. we are definitely going to get the EBIT same, because business is not going to look at, business is not going to look at where the funds are getting, right? Your business generates revenue based on its business model, based on its customer base. It's not at all affected by the fact where you are getting this money from, whether you're getting it from debt, equity, or preferential. Your customer is, totally not at all interested in that aspect. EBIT, we get, let's say, 3 lakh in each of the cases. You raise money either by equity or by debt, or a combination of debt, equity, and preferential. You are going to get the EBIT of 3 lakhs. Now, of course, what's going to change is beyond the EBIT function, because EBIT is definitely after subtracting your variable cost and fixed cost. Variable and fixed cost, they are going to remain same, whatever be the type of funding that you are looking. So from EBIT, we will reduce interest. From EBIT, we are going to reduce interest. So let's say the interest and post interest, we will be getting the amount of profit before tax. From that, we will reduce the taxes, which will give us profit after tax, right? And then from that, we will reduce the preference dividend, which will give us net profit for equity shareholder. Okay. So let's say 3 lakh for a 3 lakh EBIT. What's going to be the net profit for equity shareholder? It's computed. As far as interest is concerned, it is nil. For the second plan, interest is 5 lakh at the rate of 10%. So we can say interest is going to be 50,000. And then for plan 3, interest will be 40,000. So profit before tax comes out to be 3 lakh in the first case. In the second case, that is 2 lakh 50,000. And in the last case, it is 2 lakh 60,000. From PBT, we are going to reduce the taxes. Now, tax, let us assume the tax is going to be at the rate of 30%. For 30% tax, of course, on 3 lakh, we need the 30% amount. That's going to be 90,000. Right, 90,000. Plan 2 is going to be having a tax of 2 lakh 50 into 30%. That's 75,000. And plan 3 is going to be 78,000. So we just get the profit after tax figure. Profit after tax is 2 lakh 10,000, 1 lakh 75,000, and 2 lakh 60 minus 78 is 1 lakh 82,000. Then preference dividend, just subtract it, and what we get is 1 lakh 82,000 minus preference dividend. So preference dividend is going to be 4 lakh into 12%. So 4 lakh into 12% means the preference dividend will be 48,000, right? Net profit for equity shareholders is 2 lakh 10,000. This 1 lakh 75, and plan 3 is 1 lakh 34,000, right? Now, looking at the two numbers, now this is what we have calculated right now: 2 lakh 10, 1 lakh 75, 1 lakh 34,000. Which of these three plans is the best one to raise money? Tell me, guys. Which of these three plans is the best one to raise money from the point of view of equity shareholder? Because ultimately the business is done for the perspective of raising the wealth of the equity investors. So from the point of view of equity investors, tell me which of these three plans is the best one. So these three plans is the best one. Yeah. Plan 3. Plan 3 is the best one, or plan 1? Yeah. Well, guys, we cannot draw the conclusion based on this, because we need to actually calculate one step down to determine which plan is the best. We need to divide this by number of equity shares so that we get earnings per share. Number of equity shares, we need to divide it by number of equity shares so that we get earnings per share. The number of equity shares, we can get it simply by looking at 10 lakh divided by 10. So the number of equity shares will transform or will translate to maybe 1 lakh. The first case. For the second case, it is 50,000, and for the second case, for the third case, it is 20,000. 50,000, 20,000. And if you look at the number of the amount of EPS, well, the EPS is simply going to be 2 lakh 10 divided by 1 lakh, which is 2.1. Then 1 lakh 75 divided by 50,000, that is 3.5. And 1 lakh 34 divided by 20,000, which is 6.7. So here it is the EPS 6.7. So now looking at the EPS, if I ask you which is the best plan, well, the best plan looking at EPS should be the plan 3, because that gives us the maximum EPS for the shareholders. So whenever there is a problem in which you are making a decision about which plan should be chosen, the decision will be made on the basis of highest EPS criteria. Okay, the decision is going to be made on the basis of highest EPS criteria, always remember. And suppose one more information is given in the question. So what information? Suppose if I tell you that we have got a P ratio also. P ratio is, let's say here it is 15, 11, and 5. Okay, just for example, 15, 11, and 5. Because generally, if you are going for greater amount of outside funds, outside debt or preference share, shareholders' confidence it decreases because they feel that the company is taking excessive risk, and for that reason we may not be paying a higher price for it. So P ratio is, let's say, 15, 11, and 5. So in that situation, what will be the market price per share? Market price per share will be, obviously remember this P ratio will be given to us, okay? Not something we are going to calculate. Tell me what will be the market price per share? What will be the market price per share? That's EPS into P ratio, right? That is EPS into P ratio, because we know the formula for P ratio, correct? Yes. We know P ratio is what? Market price per share upon earnings per share. Market price per share upon earnings per share. That is, market price per share should be ideally earnings per share into P ratio. Earnings per share into P ratio. So market price per share, we will get the number over here as 2.1. 2.1 being the EPS, you multiply it with the given P ratio, which is 50. So market price per share in that situation gives us 31.5. For the second case, that is 38.5. For the last case, it is 6.7 into 5, which is 33.5. So now, if the question gives you an additional information with regards to the P ratio, then we are going to consider MPS as a basis for decision, and that gives us the answer as plan 2 should be the best. Because remember, the ultimate objective of the finance manager, the ultimate objective of finance manager is to maximize the market price per share. Ultimate objective of the finance manager is to maximize the market price per share, which is 38.5. Okay, so that's 38.5 market price per share. So that is getting fulfilled if you look at the highest MPS, then the P criteria is required. So just remember these two rules. What are the rules? If we are looking for financing plan, we should be choosing the plan which gives us the highest EPS. And if P ratio is given, then we should consider the market price as a selection criteria for the plans. Okay. So the rule is you need to choose the plan which generates highest EPS. If you look at the plan which generates the highest EPS, and rule number 2 is if P ratio is given, suppose if P is given, if P ratio is given, market price per share should be considered. Okay. P ratio is given, market price per share should be considered. I hope these two rules are pretty clear in your mind, everyone. Correct. So this is a simple rule that we are going to follow. And right now, let's take it forward with one more question to make it a bit more practical and to understandable. Let's go for question number 2, guys. And this is the question which I have uploaded on the portal, guys. The ICAI portal, I have uploaded it. You can download this question and can actually start solving it. Easy. Question number 2. I'll just give you a minute's time. Download the question in case you haven't. And then we will start with the solution for question number 2. I hope you're able to find the questions. I mean, this question sheet, are you able to get it? Yep, you're able to get the question. Usually on the portal, guys. It's not question paper, it's the assignment or notes which you can find I have uploaded. Anyways, we can see the question on the screen maybe. Let's look at this question from the screen, guys. The existing capital structure of XYZ Limited is as under: equity shares of rupees 100 each, 40 lakhs, retained earnings 10 lakh, 9% preference shares 25 lakhs, 7% debentures 25 lakhs. So this is how they are going to have their funds as of, this is the existing capital structure. Remember, this is the existing capital structure. Then it says the existing rate of return on company's capital is 12%. So as of now, whatever is invested, the business gives return in the form of 12% of the capital employed, and the income tax rate is 50%. The company requires a sum of 25 lakh to finance its expansion program, for which it is considering the following alternatives. Which are the alternatives? First, issue of 20,000 equity shares at a premium of rupees 25 per share at the rate of rupees 125, obviously, right? Because we are issuing at a premium of 25 and we find that the face value is 100, it means the issue price is 125. Similarly, issue of 10% preference shares and issue of 8% debentures. It is estimated that price to earning ratio in case of equity, preference, and dividend would be. Now, if you choose the equity source of funding, you are likely to get the P ratio of 20, or it is 17, or it is 16 respectively. Which of the above alternatives would you consider to be best? And we have to provide a reason for our choice also. Okay. So now, how do we go about solving this? Because first and foremost, whenever we are going to decide which capital structure to be chosen, we need to look at what is the total capital. Okay. We need to look at what is the total capital employed. Able to find it. I don't know. Explanation, but we will be able to get it. So here we have for question 2. Let's begin the solution. You can see it on the screen as of now. I don't know why it is not showing up on the portal. But never mind. So the first and foremost thing when we start with this type of question is to write down the capital structure, the proposed capital structure. Okay. Will they proposed capital structure? Proposed capital structure. So we are having three plans as per the information given in the question. Plan 1, plan 2, and plan 3. The first plan, we were looking at fully equity funding. Second plan, we're looking at 10% preference share capital funding. And third plan was to go for debt fund. Okay. Then we have the financing components that we're talking of. So first up, equity share capital. The existing equity share capital is going to remain same in preference share capital and debenture plan because no new additional equity shares are issued in that. For plan 2 and plan 3, the amount of equity share capital is going to be same, which is given in the question as 40 lakh. Equity share capital is 40 lakhs. Let's write down the numbers. Here we have plan 2 as 40 lakh and plan 3 is also 40 lakhs. Equity share capital. Equity share capital for the first plan where we are going to issue 20,000 equity shares at a premium of 25. Now, of course, this premium I cannot add it to the equity share capital. Where will I take this 25 premium in my books of accounts? Where will I take this 25 premium? Of course, it will go to securities premium, and securities premium is going to be part of our reserves. So, therefore, we need to also have reserves as one of our capital structures. So equity share capital for plan 1. Plan 1 equity share capital is going to be originally it was 40 lakh, right? And additionally, 20,000 shares are issued, which are having a face value of 100. Plan 1 equity it is going to be 40 lakh plus 20 lakh, that is 3 lakh. Reserves are basically going to be 10 lakh is given in the question. Retain earnings of 10 lakh and added to it retain earnings of 10 lakh and added to it the securities premium. Securities premium is basically which is the 20,000 shares into 25. Right, so 10 lakh plus 5 lakhs, so reserves will become 15 lakh. Reserves will be 15 lakh for plan 1 and plan 2 and plan 3 reserves are still going to remain same 10 lakh itself. And for plan 3 also reserves are 10 lakh. Perfect. So that's what we have got for plan 1. And the other structure, the components of capital structure is 9% preference shares. 9% preference shares and the existing capital also comprise of 7% debenture. 9% preference shares and 7% debentures. Now 9% preference shares as we have in the question, that's 25 lakh and that's going to be constant for all the 3 plans because there's the capital is existing as of now. 9% preference shares, 25 lakhs. And 7% debentures, it's going to be again the balance 25 lakhs. But there are new preference shares and debentures that are getting issued at different levels. So here we have issue of 10% preference shares, which is the plan 2, and issuing 8% debentures as far as plan 3 is concerned. We have the new capital coming in the form of 10% preference shares, 10% preference shares, and 8% debentures. 10% preference shares and 8% debentures. So as far as 10% preference shares, nothing is going to be in the plan 1 because the plan 2 talks of 10% preference shares. So there we are having a preference share amount of 25 lakhs and no new debentures in that case. And the plan 3, obviously, we don't have new preference shares, but we do have new debentures. And then we take a total. So obviously, total is going to be like 1 crore 25 lakh is the total capital. One crore 25 lakh is the total capital that we have. Okay. Now, one important thing is the company's existing rate of return is 12% and income tax rate is this. Now, there is nothing specified as to whether there will be any improvement in the total capital, improvement in the return on capital employed. So our assumption is going to be simple that whatever was your return on capital employed earlier, that same rate is going to continue even for the next years. So on this, we will be computing EBIT, earnings before interest and tax, which is simply going to be at the rate of 12% of total capital employed. EBIT of 12% of total capital employed. We have 12% of total capital employed. So that's going to be 1 crore 25 lakh into 12%. 1 crore 25 lakh into 12%, which is going to be pretty simple figure. That's going to be 12% of this. That's 15 lakh. Now, irrespective of from where you are raising the money, EBIT is going to be same, which is 15 lakhs. EBIT is going to be the same, which is 15 lakhs. From that, we need to subtract the interest. Now, interest we are going to subtract on two type of debentures wherever they are, 7% debentures and 8% debentures. So let us subtract interest on 7% debentures and 8% debentures, which will give us, after subtracting them, we will have the profit before tax. And from the profit before tax, we subtract the tax figure, which will give us profit after tax. Of course, we're not going to stop over here. I need to further subtract the preference dividend. Now, again, in case of preference dividend, we are going to have a set of preference dividend. One is on 9% preference share, another on 10% preference share. Preference dividend on 9% preference share and on 10% preference share. Okay. So after subtracting this, we get net profit for equity shareholders, which we divide it by number of equity shares so that we get the EPS. But as we know, we are not going to stop at EPS, but rather we are going to consider the P also into the calculation. So as far as P is concerned, that is given in the question. P is given in the question as 20, 17 and 16. P is 20, 17 and 16. That will give us market price per share. Right? So that's how we can get the market price per share number. Now, it is quite obvious that this numbers we can compute it easily from the we can compute these numbers from the capital structure figure itself. So let's say 7% debentures, 8% debentures. The interest component, we'll have the interest component. What will be the interest figure? Say 7% of 25 lakh. So 7% of 25 lakh is going to be 1 lakh 75,000. 8% debentures, it is nil. There's no 8% debentures in plan 1. Right? So we have the profit before tax as 13 lakh 25,000. Then 8% debentures, that's going to be there for the second case also, and also for the third case. And in the last case, the debenture will be also considering the 8% debenture. So on 25 lakh, 8% debenture, that is 2 lakh. So 15 lakh, out of 15 lakh, you subtract 1 lakh 75,000. 13 lakh 25 is the PBT. But in the last case, since you have additional debentures, now the PBT falls to 11 lakh 25,000. The tax rate is provided in the question. Tax rate is going to be considered as 50%. 50% is going to be the tax. So out of 13 lakh 25, 50% should be paid as tax, which means 6 lakh 62,500 is the tax figure. And that's going to be there 6 lakh 62,500 even for the last next third plan also. For the third plan, it will be the tax is going to be 11 lakh 25,000 into 50%. That is 5 lakh 62,500. Yeah. We get the profit after tax figure. Now, preference dividend is going to be a differing pattern. Uh, as far as first plan is concerned, 25 lakh into 9% is the preference dividend. So 25 lakh into 9%, that will be 2 lakh 25,000. Since this is the older capital that's going to be there, 10% preference shares. So we have the new set of preference share for this 25 lakh capital. So on 10%, we have 2 lakh 50,000. So on subtracting the preference dividend, we get 6 lakh 62 minus 2 lakh 25, which is 4 lakh 37 500, 1 lakh 87 500, and 562 minus 225 is 3 lakh 37 500. Now divide this by number of equity shares. Now the number of equity shares we know from the share capital itself. We got 60,000, 40,000. And even the last one is 40,000. EPS is 4 lakh 37 divided by 60, which is 7.29. 1 lakh 87 500 divided by 40 is 4.69, and 3 lakh 37 500 divided by 40 is 8.44. P ratio is 20, 70, and 16. Market price per share works out to be 145.8, 79.73, and 135.04. Okay, so this is your market price per share. Of course, as a decision making tool, where are we really going to look at? We are definitely going to choose this financing plan, the first financing plan, because that gives you the highest share price, and which is targeting the wealth maximization objective of the shareholders. Right? Are we clear with this? The plan one, we get the market price of share to be highest for plan one, and therefore we are choosing the same. Very good. Very good, guys. As far as question two is concerned, no queries, right? Without knowing the WAC, how can we decide which plan is met? Mr. Srinivasan, this is, we are looking at the plan from the basis of wealth maximization objective of shareholder. Now, obviously, wealth will be maximized when the weighted average cost of capital is lowest. And that's what we are targeting it. Because if you're looking at a plan where the market price is highest, it means it's that plan which is ensuring that WAC is the lowest one. Weighted average cost of capital is the lowest one in that. Are we good with the second question? Then we will go for a third question, which is a bit of more challenging. So what will be the right and the reason? Of course, we're going to, the reason will be wealth maximization. Reason we can simply write over here as funds should be raised by issuing equity shares, as it will lead to maximum market price per share and ensure wealth maximization of shareholders. Ensure wealth maximization of shareholders. Okay, that's the reason which we are going to write. Okay, now let's go for question number 3, guys. Let's look at question number 3. XY Limited provides you with the following figures. We have the profit, which is obviously EBIT of 2,60,000, and interest on debentures of 12%, 60,000. Right now, if suppose interest is 60,000 and the rate is 12%, can you tell me what would be the amount of debenture that the company has in its capital structure? What is the amount of debenture that the company has in its capital structure? Can you tell me? If interest amount is 60,000 and rate is 12%, what is the amount of debenture that the company might have issued? Yeah, 5 lakhs. Perfect. So that's like 60,000 divided by 12%. So profit before tax, they've given us 5 lakh. Income tax 50%, profit after tax 1 lakh, number of equity shares is 40,000. Earnings per share is 2.5. Then we have the ruling market price as of now, which is 25, and that makes the P ratio, price to earning ratio, as 10. Then it says that company currently has undistributed reserves of 6 lakh. It has got undistributed reserves of 6 lakh. Company needs 2 lakh for expansion. The amount will earn at the same rate as funds already employed. You are informed that a debt equity ratio, debt to total capital, higher than 35%. So if your debt total capital ratio, I mean, from the total funds that you're employing in the business, out of that, if you have a debt which is higher than 35%, so proportion of debt, if the proportion of debt is higher than 35%, then the P ratio will go down to 8 and raise the interest rate on additional amount borrowed to 14%. You are required to ascertain the probable price of the share. You have to calculate the probable price of the share under each of the plans. What are the plans? If additional funds are raised as debt and if the amounts are raised as equity. There are two combinations that we are talking of. If you are going to raise the money as debt, then what will be the case? And if you are raising at equity, then what will be? Anyways, you find over here that interest rate on additional borrowing will be 14%. So we're going to have a new type of debt in our capital. And of course, if you're going to issue equity shares, we will be definitely issuing them at the ruling market price of 25, because there's nothing other thing mentioned over here. Okay, so let's get started with the solution. Kumar Parikh, just what do you mean by P ratio? P ratio is price to earning, market price per share divided by earnings per share. Let's look at question number 3. First, we need to decide capital structure. The current capital structure. Current capital structure that we need to first decide, or first we need to calculate what is the current capital structure. Well, as we have seen, current capital structure comprise of equity shares. So first, let us say, what is the amount of equity share capital? Equity share capital will be 10 rupee. right? Face value of 10 into the number of shares that we have. Number of shares is 40,000. So the equity share capital amount will be 4 lakh. They've stated that company has got a undistributed reserves. The company has got an undistributed reserves of 6 lakh. So accordingly, we can say reserves amounting to 6 lakh. Then we have the debentures. The debentures are going to be interest on debentures at 12%, which is simply 60,000 divided by 12%. I think you guys have only answered the amount of debentures. Debentures are going to be 60,000 divided by 12%. That comes out to be 5 lakh. So total capital employed is 15 lakhs. Total capital employed is 15 lakhs. Now to obviously select the appropriate plan, we need the current return on capital employed also. Current return on capital employed will be EBIT, which is earnings before interest and tax, upon total capital employed into 100. So as of now, what's the EBIT that we have? 2,60,000 upon a total capital employed of 15 lakh, right? So the EBIT upon total capital employed, it means current return on capital employed is 2,60,000 divided by 15 lakhs in 200, which makes it as 2,60,000 divided by 15 lakh as 17.33%. Current return on capital employed will be 17.33%. Okay. Now this 17.33% return on capital employed will be used for computing the capital structure results. Let's write down the proposed capital structure. The amount that we need as an additional funding that we are considering as of now into two plans. The first plan is to raise it in the form of additional debt, and second plan is to raise it in the form of equity. Okay, so we are going to have the equity share capital, the reserves, and also the debentures. But rather, debentures are going to be of two categories: old and new. Old debentures are going to be at a rate of 12%. New debentures are going to be at a rate of 14%. Okay. Right. So if you are looking at the debenture plan, of course, the equity share capital then it will remain same as this 4 lakh, right? So by way of debt, equity share capital is remaining same as 4 lakh. Reserves are also going to remain same, 6 lakh. And the old debentures, which we are still going to have, that's going to be 5 lakh. The additional debentures that we are going to raise will be at a rate of 14%. And what is the additional funds that we need? The additional fund that is needed is 2 lakh. So let us write down this 2 lakh as an additional debt. So that's something which makes the total capital employed, the proposed capital employed, to be 17 lakhs. As far as plan 2 is concerned, for equity, we have the equity share capital as 4 lakh, but at what price are we really going to issue? So let me just do a calculation for you. Now, funds to be raised, funds to be raised will be 2 lakh. If you're going to raise these funds by way of equity and no, by way of equity issued at a certain price, current market price, the ruling market price is 25 rupees. So if I ask you what will be the number of equity shares to be issued, what will be the number of equity shares to be issued? That will be 2 lakh divided by 25, which is 8,000 shares, right? Now, of course, on these 8,000 shares, you are going to issue at a price of 25. So this 8,000 shares are going to be categorized into two parts. One is the face value that we are going to talk of, and the other is the securities premium. So at face value means 8,000 into 10, which is 80,000, and securities premium will be 8,000 into 15, because when you're issuing the shares at a price of 25, it means 15 is the applicable securities premium, which is 1 lakh 20,000. Securities premium is 8,000 into 15. Now, plan 2, we have for as far as equity is concerned, equity share capital, that's going to be the original 4 lakh plus 80,000 shares face value. So this will become like 4 lakh 80,000. The reserves will increase by 1 lakh 20, which will make it as 7 lakh 20,000. Debentures, old debentures are still continuing same, 5 lakh. And new debentures, of course, not applicable in this case because we are issuing equity shares. Then total capital employed is 17 lakhs. Now, debt to total capital employed. Now, why are we really computing this? Because there was a point in the question, guys, because you see, let's say it's a debt to total capital. If the ratio of amount of debt total capital, if it is higher than 35%, means if this ratio is greater than 35%, the implications is going to be a bit different. Now here I have presumed it to be 14%. Let me see if it is really correct or not. Because as per our original estimate, you can say it is debentures totaling up to 7 lakh out of 17,000. So if you say debt to total capital employed ratio, that is 7 lakh upon 17 lakh. The second case, it is 5 lakh upon 17 lakh. 7 lakh upon 17 lakh is 41.18%. And for the second case, it is 29.41%. Now, obviously, sir, this is greater than 35%. What will be the implication? Implication is that the cost is going to be 14%. It means what we have assumed as, but otherwise we would have taken it at 12%. Otherwise, we would have taken it at 12%. So debt to total capital employed exceeding the 35% criteria, and therefore this is going to be at the rate of 14. There is another implication that we have for this debt equity ratio. Your P ratio is also going to be different. Now the P ratio, due to this exceeding 35%, P ratio will become 8. And the plan to, in the second case, in the equity, that the P ratio will remain same as 10%. Okay, so this will be the new P ratio, and this is the old P ratio will continue because the percentage is less than 35%. Okay, so this is what we have got. Now we can simply begin with the EBIT. From this, we are going to reduce the interest. We will get profit before tax. Okay, and from that, we will reduce the taxes. We get profit after tax. There's no preference dividend access. So you can write down number of shares, P ratio, and then finally the market price first. So we have this entire income statement ready. Let's try to fill it up. 7 lakh, 5 lakh कहाँ से आया? 7 lakh, 5 lakh. Not 7 lakh, it's 2 lakh. In the question, it has stated that you are informed that a debt equity ratio, which is a specific debt equity ratio given over here, debt to total capital, it is higher than 35%, it will push the P ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. So we checked the debt to total capital employed ratio. Now, debt to total capital employed is what? Debt is this 5 lakh plus 2 lakh. Because in plan one, where you're raising the money by way of debt, you will consider both 5 lakh as well as 2 lakh. So 5 lakh plus 2 lakh, which is 7 lakh out of total 17 lakh. So 7 out of 17, it means 41.18%. And as far as plan two is concerned, it is just 5 lakh out of 17 lakh. We compute this ratio. We find that out of our total capital, 7 lakh is the debt amount, which is 41.18%. And as per the question, if this exceeds 35%, investors foresee a greater risk in it. And for that reason, investors foresee a greater risk in it. And for that reason, you are looking at a lower PE ratio and also higher cost of capital. Okay, I hope this makes sense. Now, higher cost of capital and PE ratio does not impact the equity plan because there the ratio is within the tolerable limits. Okay, now let's look at the income statement and then try to draw the conclusion which plan is the best one. So we begin with EBIT. Now, what is going to be the EBIT figure? Well, guys, the EBIT is pretty simple. That's 17 lakhs into the existing return on capital employed. The business is such that as of now, the business is able to generate 17.33% return. So EBIT will be 17 lakh into 17.33%. So that gives us an EBIT of 2 lakh 94,610. 2 lakh 94,610 the EBIT. From that, we are going to subtract interest. Now, of course, interest is again going to be on two aspects, on old debentures as well as new debentures. So on 5 lakh, we are having the 12% criteria. On 5 lakh, we have the criteria of 12%. So on 5 lakh, 12%, it means that's going to be 60,000 plus, so 5 lakh into 12% 60,000 plus 2 lakh into 14%. 2 lakh into 14% is 28,000. So 28,000 plus 60,000, which is 88,000. Interest is 88,000. And the second case is on this 5 lakh, we have got 12%. So interest cost in second plan is remaining same as 60,000. Profit before taxes out of 2 lakh 94, 88,000 is the interest. So profit before tax will be 2,06,610, and this is 2,34,610. Now the tax rate is anyways 50%. So out of PBT, half of it will be paid as tax. The tax will be 1,03,305. Profit will be also same, 1,03,305. Number of shares is 40,000. Earnings per share will be 2.5. P ratio is 8. Market price per share, you can just multiply it to 8 into 2.58, which is 20 point. Then for the second case, the tax will be 1,17,305. Number of shares is 40. I mean, even the profit after tax will be 1,17,305. Number of equity shares is 48,000. Earnings per share is 2.44. P ratio, as we have decided, it was 10. Market price per share will be 24.4. So which plan of financing are we really looking to choose at? 24.4. That's the highest NPS, and therefore we say plan 2 should be chosen, right? Plan 2 should be chosen because it leads to maximization of shareholders' wealth. So it should be raised by way of equity. Perfect. Is this clear, guys? The third question. Is question 3 clear to everyone? Not question 3, basically solution to question. The solution to question 3 clear? It is clear, everyone? Clear? Okay. Okay, great. Now, let's take up a concept, really interesting concept called as break even. We're going to learn something called as financial break even. Financial break even point. So this is basically what we are going to discuss. But before we go to financial break even, just tell me what is break even point? Just tell me what is break even point. Tell me normally what do you mean by break even point? Tell me guys, what do you mean by break even point? Yeah, tell me. Waiting for your answer. No profit, no loss situation. No profit, no. I know what is no profit, no loss. I know. But suppose if I tell you 10 lakh is the break even point, what is that 10 lakh? If I say break even point is rupees 10 lakh, what is that rupee 10? I say 10 lakh is the break even point. What do you mean by that rupees 10 lakh? Well, break even point is the sales level at which profit is equal to zero. Okay? It's the sales level at which profit is equal to zero. Similarly, if we have financial break-even point, we are talking of earnings before interest and tax at which EBIT at which net profit for equity shareholders is equal to zero. Financial break-even point is EBIT at which net profit for equity shareholders is zero. Financial break-even point is the EBIT at which net profit for equity shareholders is zero. So it means when we start with EBIT, we subtract the interest, we get the profit before tax. From that, we subtract the tax, then we get the PAT, and then from that, we subtract the preference dividend, and then we get the net profit. So we're talking of a break-even point, EBIT level, where it will lead to a net profit for equity shareholders to be zero. Obviously, now we need to definitely pay the fixed cost. So suppose fixed cost is, let's say, interest is 10,000 and preference dividend is suppose 15,000. So interest of 10,000 and preference dividend of 15,000 is the applicable fixed cost. So if I ask you to compute, do the reverse calculation to arrive at EBIT such that your net profit is zero. So how can we do that? Can you tell me what will be the EBIT which will lead the net profit as? Please do the calculation. Take the tax rate as 40%. Do the calculation and tell me what should be this EBIT level, which will make the net profit for equity shareholders as zero. Yeah. What will be this EBIT level, which will ensure that net profit is zero? You can do this reverse calculation, right? So reverse calculation involves like if your preference dividend is 15,000, what will be the profit after tax? Profit after tax also should be 15,000. Because if your PAT is 15,000, from that 15,000 preference dividend to be subtracted, net profit for equity shareholders to be zero. Now, if your preference dividend is 15,000, your PAT should be 15,000 to make the net profit as zero. So what should be this PBT and this figures? So that we can get it simply by looking at PBT as 100, tax is 40, PAT should be 60, 10, 40 and 60. This is what the simple ratio should be, right? So if 15,000 is 60%, what should be PBT? We can simply perform the cross multiplication. And on doing the cross multiplication, we get the profit before tax figure as 25,000. And tax rate is 10,000. And on doing the further reverse calculation, we find EBIT as 35,000. EBIT is 35. From that, you're paying interest, you get a PBT. Tax is 10,000, PAT is 15, preference is 15, net profit is zero. It means if your EBIT is 35,000, it will make your net profit as zero. Now, if I ask you, suppose EBIT is more than 35,000. If your EBIT is more than 35,000, suppose your EBIT is, let's say 40,000. Can you predict what is the likely result of the net profit for equity shareholders? If it's going to be greater than zero or lower than, that's the only question I ask. If your level of EBIT is more than 35,000, then is your net profit going to be positive or negative? Of course, positive, because you are crossing the break-even point, and that will ensure, as you cross the break-even point, that will ensure that you are in the profitable territory. EBIT of 40,000, from that you deduct the interest of 10,000. Then you get a profit before tax of 30,000. Now we apply the tax rate of 40%, which is 12,000, and PAT is 20, sorry, PAT is 18,000. From that 18,000, you pay a preference dividend of 15,000, and that becomes 3,000. Okay. Now, similarly, suppose if your EBIT level is lesser than 35,000. So if it is, let's say, 30,000, what is your prediction about the net profit? Is it going to be positive, negative? Of course, negative, because below break even, it means you are going to generate losses. You can just observe that interest will pay at 20,000. You have 20,000 as PBT. Tax will be 10,000. Then you have a PAT of 10,000. Preference dividend, you have to pay 15,000. Tax rate is 40%. That's 8,000. And this is 12,000. So we have a 3,000 negative, right? The point is, if your EBIT is same as financial break-even point, if your EBIT is same as financial break-even point, then we say net profit for equity shareholders is zero. Whereas if your EBIT is less than financial break-even point, then we say net profit for equity shareholders is positive. And if your EBIT is greater than financial break-even point, then net profit for equity shareholders is going to be negative. So I would just like to draw a diagram to represent this break-even point. You can simply look at it like this. This is our net profit figure. And here we have the EBIT. There will be a point of EBIT which will make the net profit as zero. And as you grow with EBIT, net profit for equity shareholders, or you can say you look at the coordinates, as the EBIT keeps on increasing, the net profit for equity shareholders will increase. But this point is the financial break-even point. Below the financial break-even point, you have negative net profit for equity shareholders. And above this, it's going to be positive. Above this is going to be positive. Right? Now, how do we really know, sir? How did you do this calculation? We did a reverse calculation. Other way around, we have got a formula also for financial break-even point. For financial break-even point, the formula is preference dividend upon 1 minus T plus interest. We can just verify what we have done over here. Interest of 10,000 plus preference dividend upon 1 minus T. Now, preference dividend was 15,000. So we'll take that as 15,000 upon 1 minus 0.4 plus interest of 10,000. 15,000 upon 0.6, which is working around what, 25 plus 10, 35,000. And that is what we see over here as 35,000 in EBIT. Okay. Right. So we need to remember this formula, by the way, guys. Financial break-even point is preference dividend upon 1 minus t plus interest. Now, what's the use? What's the analysis of financial break-even point? Financial break-even point. So let's say we have got three plans: plan one, plan two, and plan three. We look at their financial break-even point. We look at the financial break-even point of all the three plans. First plan has got a financial break-even point of 35. Second plan has got a financial break-even point of 50,000. Third one has got a financial break-even point of 15,000. If I ask you which plan is having a higher amount of risk, tell me. You understand financial break-even point? It is the level at which your profit or loss is zero. Beyond that, you start making money. Below that, you're in the negatives. So if we have these three type of plans where the financial break-even point is 35, 50, and 15,000, what can you say about the riskiness of the plan? Which plan is riskier? Which plan is less riskier? Or which plan is highest, which is having the highest risk? Yeah, guys, tell me. Which plan is having the highest level of risk? See, this plan has got a highest level of risk because to make your business profitable, you need to at least earn 50,000 in EBIT. This is going to be the highest risk. This plan has got the lowest amount of risk because to make this business profitable, we need to earn just 15,000 in EBIT. So beyond 15,000, we start making profits. And here it is beyond 50,000. Of course, this plan is going to be lesser risk. We can say this has got a high, this medium, and this has got low risk. Okay. So financial break-even point is a parameter of riskiness. Higher the financial break-even point, higher is going to be the risk involved. Are we clear with it? Yeah, guys. So that was what we said about financial break-even point. I hope this makes sense to everyone. Yeah. Parth Sarat is asking if EBIT is less than financial break-even point. Net profit for equity shareholders is negative. Uh, yeah, it's going to be negative if your EBIT is below the financial break. Okay, so let's do one thing. Let's take a break right now, guys. Uh, Break of 10 minutes, and then we'll begin with the next concept, which is the indifference point, and the other set of concepts and discussions that we're going to take. Let's take a break, guys. Break of 10 minutes. You soon. Welcome back, guys. After the break, um, we have seen just before the break what is a financial break-even point. Okay, sorry guys for a technical issue. Okay, so we have seen the financial break-even point concept. Now let us go for next question based on this. Let's look at question number 6 right now. Question 6, which will give us an application of okay. Hypothetical Limited is in need of 1 lakh to finance its increased net working capital. Finance manager of the company believes that its various finance cost and share price will be unaffected by the selection of a particular plan, since a small sum is involved. Debentures will cost 10%, preference shares 11%, equity shares can be sold for 25 per share, and tax rate is 35%. First plan is to raise it by way of equity shares. Second plan is to raise equity, preference share, and debentures. And then the third plan is again the ratio. So first, we'll look at the question. It says calculate the financial break-even point and which plan has got a greater risk, assuming EBIT level of 50,000. So I need to first write down the financial plans. The finance plans we need to write down. Then we can think of possible, break-even point calculation. So let's say plan one, plan two, and plan three. We are looking at raising money to the tune of 1 lakh. So plans are basically equity, fully 100% equity, and then preference share and debt, preference share capital and debt. So it's 100, 0, 0. So 100 is basically 1 lakh. Preference share and debt is nil. Next, plan two, we have that as 30, 10, and 60. So that's 30,000. Preference share capital of 10,000 and debt of 60,000. That totals to 1 lakh. Third plan is to raise it by way of 50, 20, and 30, like 50,000, 20,000, and 30,000. Now, the preference share capital are warranting a preference shares 11% and debentures at 10%. Okay. So, we need to compute the amount of preference dividend and also the amount of interest. So, in plan one, there's no preference dividend, no interest. In the second plan, uh, preference dividend will be 1,100 and interest will be 6,000. In the third plan, it will be 2,200 and 3,000. And then we say financial break-even point. In plan one, financial break-even, we simply use the formula. Preference dividend of 1 minus T plus interest. So preference dividend This is anyways going to be nil because there's no preference dividend, no debt. So financial break-even point is zero. The second case, it is 1,100 divided by 1 minus the tax rate given in the question is 35%. It's minus 0.35. 1,100 divided by this and plus 6,000. So that's like 7,692.31. And in the second case, it is 3,000 plus 2,200 divided by 1 minus 0.35. 3,000 plus 2,200 minus 0.35. This is 384.6. Okay. So now the question asks us, determine the financial break-even point. That is done. Which plan has got a greater risk? We need to know which plan is having a greater risk. Can you tell me which plan has got a highest risk? Of course, the risk is high over here. Here it is moderate, and here it is the least risky fund. Okay, so that's your break-even point and the calculation of using of that thing for the purpose of determining which is having the highest and the lowest level of risk. Perfect. Now let's go for the next concept, which is indifference point. Do you guys know anything about this indifference point? Can you tell me what's the indifference point? Ever heard of this term indifference point, guys? What do you mean by the term indifference point? Any idea is indifference point? No? Anyways, let me just take it forward as far as financial indifference point is concerned. So we are looking at the concept of financial indifference point. So what do you mean by financial indifference point? Remember this. The term financial indifference point is simply that level of EBIT. Financial indifference point is that level of EBIT for both plans at which EPS are equal. We're talking of financial indifference point is that level of EBIT for both plans at which EPS are equal. EPS for both the plans should be equal. So let us say we have got two plans. And let me just write down the flow of the income statement starting with EBIT less interest, PBT, Then from that we deduct the tax, so we get PAT. From that we deduct the preference dividend, we get net profit for equity shareholders. Then divide this by number of equity shares, and we have the EPS. So what are we really looking at? Let's say if we are having both the plans, the amount of interest will be different. Uh, then the amount of preference dividend will be different, and of course the number of shares are going to be different. So suppose I tell you that interest is 30,000 in the first plan and 10,000 in the second plan. The first plan doesn't have any preference dividend payment, but the second plan has got 40,000 preference dividend payment. Number of equity shares in plan 1 is 12,000, and number of equity shares in plan 2 is 10,000. And we want to know what is the amount of EPS. Okay. So now the point is we want to know the amount of EPS at which the amount of EBIT at which EPS of both plans are equal. We want to know the amount of EBIT such that EPS of both plans are equal. How do we really do that? How do we really know what is that thing? So we'll say EBIT is X. Let us say EBIT is X, right? Okay, so let us say EBIT is X and we want to calculate the EPS. So let's first set the formula for EPS computation of any particular plan that we are looking at. We know EPS can be computed as earnings before interest and tax. From that you subtract the interest. Now this component, EBIT minus interest, this becomes profit before tax. Right? This is our profit before tax. Minus from that, we are going to subtract EBIT minus interest, which is again this profit before tax, multiplied by tax rate. This is simply the amount of tax that has been computed. PBT minus tax, this gives us the amount of profit after tax. And from that, we are going to subtract the preference dividend divided by number of equity shares. This is a typical format that we have for computing EPS of any plan. To take use of any plan, this is the format applicable. We just try to make it a bit more easier. What you can say is EBIT minus interest is a common term. Let us take EBIT minus interest being a common term and 1 minus T, right? So you have 1 minus T over here. And from this, you subtract the preference dividend divided by number of equity shares. Whatever are the applicable numbers, you can just fill in this and get the EPS value or this expression or quick. So using the same thing, suppose for plan 1, I'm looking for EPS of plan 1. Let us take the EBIT as X, right? So X minus 30,000 being the interest in the first plan into 1 minus tax rate is let us say 0.5 for the easiness for the computation. 0.5 minus do we have the preference dividend first one? No, there's no preference dividend. And this we divided by number of shares as 12,000. And then we have EPS of plan 2 as x minus 10,000 because interest is 10,000, right? And then this into 1 minus zero point 0.5 minus a preference dividend of 40,000 divided by number of shares was 10,000. Now, since we want to equate both the plans' EPS, since we want to equate the EPS of both plans, we will say EPS of plan 1 is same as EPS of plan 2. So if we just equate both of them, we can just solve it arithmetically and get the value of x. Let's try to get the value of x first. X minus 30,000 into zero point 0.5 upon 12,000 is x minus 10,000 into zero point 0.5 minus 40,000 upon 10,000. We can just cancel this triple zeros and say 0.5x minus 15,000 is equal to 0.5x minus 5,000 minus 40,000. Okay. And this is divided by 12 and this is divided by 10. Then we can say it is 0.5x minus 15,000 upon 12 is same as 0.5x minus 45,000 divided by 10. And then we undertake a cross multiplication. 5x minus 1,50,000 is equal to 6x minus 45,000 into 12. 5,000 into 12 and 5 lakh 40,000, right? So we get this as taking all x on one side, we have 5 lakh 40,000 minus 1 lakh 50,000 equal to x. It is going to be 3 lakh 90,000. So let us apply this 3 lakh 90,000 in our table and let's see if the EPS works out to be same. Let us say this is 3 lakh 90,000. Your PBT is 3 lakh 60 and 3 lakh 80. Tax is at the rate of 50%, so 1 lakh 80,000. And this is 1 lakh 90. That also works out to be the same thing. Net profit for equity shareholders is 1 lakh 80,000. 1 lakh 50,000. So if we divide the number of shares, we get the EPS figures as 15. And again, this is here we observe 3 lakh 90,000 is working in our favor. I mean, that's the financial break-even point. Sorry, that's the indifference point where both the plans are having a same EPS. Both the plans are having a same EPS. Okay. Now, how is this EPS really relevant, or how is this really important for the calculation purpose? Let me just show it to you. Let me just show it to you in the form of an Excel working, because that will actually make the things more interesting and intuitive, just show it to you by way of Excel calculation. Just open a new file. Okay. So we just computed the financial break-even point for a plan, correct? So let me just rewrite that entire thing over here. PIT less interest, we get profit before tax, less tax, get profit after tax, less preference dividend, net profit for equity shareholders, and we have number of equity shares and so we said that 3,90,000 was the indifference point because there we found that the EPS was working out to be same, right? We find that they are both are same, right? Both of them are same as far as if your EBIT is 3,90,000. Okay, so for a EBIT level of 3,90,000, we find that both of them are giving us the same EPS. Now, suppose we have a similar setup in which I'm saying that now the EBIT is, let's say, 4 lakh, which is definitely higher than the indifference point. So we observe that if it is 4 lakh, then this works out to be 15.41 as the EPS. 15.5 is the EPS for the second. And on a similar line, if we take a EBIT of lesser than 3 lakh 90, let's say 3 lakh 80,000, we observe some different numbers, right? So here at a higher EBIT level, second plan turns out to be better, and at lower EBIT level, the first plan turns out to be better, right? So just try to color code this. Yeah, so you can see the first plan is giving you lower EBIT, second plan is giving you a higher EPS. If your EBIT is 4 lakh, if it's 3 lakh 80, then the inverse happens. So what does it really imply? What does this really imply? So for that, let us do one thing. For both the plans, let us compute the financial break-even point. Financial break-even point will be uh, the preference dividend divided by 1 minus 0.5 plus interest, right? So based on this, we can also say risk level. The first plan is having lesser risk. Second plan is having a higher risk, right? First plan is having a lesser risk. Second plan is having a higher risk. Hmm. So risk is accordingly computed. Fine. So we say that for a higher level of EBIT, can I say a high risk plan is preferred, whereas for a lower level of EBIT, a less risk plan is preferred, right? So if we are looking at the indifference point, uh, if the EBIT level is more than indifference point, like in this case, if your EBIT level is more than indifference point, then you look at the plan which is having high level of risk or high risk plan, which it rewards you. Whereas if your EBIT level is less than break even point, less than indifference point, then a lesser risk, uh, then a lesser risk thing is lesser risk plan is going to be preferred. Okay, is this clear, guys? Okay. Yeah. So this is the case of indifference point. Now, if you just try to visualize a bit, you can simply look at a chart. I'll just show you the chart, which will give you more clarity about what we are really talking of. Yeah, I'll just draw the chart over here. Or else we can we have a chart created for you in this thing itself. Let's say EBIT, and we'll say EPS of plan 1 and EPS of plan 2. So let's say EBIT levels are, because indifference point was 3 lakh 90, right? So let me just look at maybe 3 lakh and just keep on increasing by 10,000 every time. I'm just looking at various possible EBIT figures. And EPS, because let's just apply the formula, which is going to be EBIT minus interest of 30,000 into 0.5, which is the after tax effect. And there's no preference dividend as such. Just need to divide this by 12,000. And for the second plan, it's going to be EBIT minus interest of 10,000 into zero point 0.5 minus preference dividend of 3,000. And then this entire thing divided by 10,000. Then I just drag it. We get the multiple EPS, and what we observe is over here 3,90,000, 15 is the same EPS. And if I just try to chart out uh, the diagram, it's on this. Anyways, over here, what we can see is this particular portion has got a higher level of EPS, and this particular portion has got a higher level of EPS. What we observe is for a lesser level of EBIT, the plan with less risk is preferred. And if you go beyond the indifference point, then you start favoring the second plan which is having a higher EPS. And if I just try to chart these three things, just show you how that's gonna look. Insert a chart for you. Yes. Yeah. This is how we are getting the chart. Yeah. You can observe if we have a detailed look at the chart is that they are moving in a form of X manner, and there's this point of intersection. This point of intersection is what we mean by indifference point. Okay. So we really want to have, well, the chart will somewhat look like this. I'll just do it in the we have y-axis is representing EPS, x-axis which is representing EBIT. Okay. So we have this plan. Let's say this is plan one. And then we have another plan, this plan two. Now there, this is typical indifference point that we are talking of, where EPS of both the plans and EBIT of both the plans is same. Now, as you move beyond this, just name it differently. Beyond this, plan two is preferable, and below that, plan one is preferable. See, below the indifference point, this particular line is dominating. So here we can say below indifference point, plan one dominates. Beyond indifference point, we say plan two dominates, right? So if a typical plan is less risky, then it's going to be favorable for the EBIT level lesser than indifference point. So as a conclusion, what we can observe here is if plan is less risky, EBIT lesser than indifference point is suitable, And suppose if plan is more risky, then EBIT greater than indifference point is suitable. Okay. So this is the course of decision or action that we need to look at. That's the simple interpretation of indifference point. Lesser than indifference point, uh, if your rebate is lesser than indifference point, that is favorable only if you are going with a less risky plan, and if it is if you're going for the other plan, it needs to be a high risk plan because high risk will require a higher level of EBIT also. Okay, so let me just do one question. Question number 11. Let's try to solve this question number 11. Yeah, look at this question number 11 guys. Read it. Read question number 11 once. Yeah, the key information regarding the proposed new financing plans have been given. Hmm. Key information pertaining to the proposed new financing plans of hypothetical limited is given below. So we have two financing plans. One is equity, preference share, and debentures, assuming 35% tax rate. Determine two EBIT EPS coordinates for each financial plan. Determine the indifference point and financial break-even point for each financing plan. Which plan has got more financial risk and why? Indicate uh, over what EBIT range one plan is better than the other. Okay, so let's write down the plan first. With the plans, we have the equity share capital, preference share capital, and we also have the debentures. Equity share capital is 15,000 shares of 100 each. That's like 15 lakh. Preference share capital is 25,000 into 100, which is 25 lakhs. Debentures is okay, not applicable over here. Debentures is we have, yes, 5 lakh. 5 lakh at a coupon of 0.1. So yeah, 5 lakh is the amount of debenture. Well, this preference shares are having a cost of 12%. Debt is having a cost of 10%. Plan 2, we have 30 lakh equity share capital. Preference share capital is not there. And yes, 15 lakh is the debenture at 11%. We have the total capital employed as 45 lakh. We got the interest and the preference dividend. Interest is 50,000. Preference dividend is 3 lakh. Plan 2, interest is 1,65,000 and preference dividend is nil. So the question asks, what is, first of all, we need indifference point, financial break-even point for each of the financial plans. So let's compute the financial break-even point because that's easier to calculate. Adopt the same strategy in exams also. First try to solve those questions which seems to be easy to you. Financial break-even point is 50,000 plus 3 lakh divided by 1 minus 0.35. And in this case, the indifference point is 1,65,000. Here it is 5,11,000 by 38. And this is 1,65,000. This is going to be more risky. And this is going to be less risky. Okay. So we have answered the answer question, which that's the financial break-even point, which one has got more risk and why. And now it's time for us to calculate the indifference point. Now for indifference point, we'll have to use the EPS formula. EPS of plan 1 will be x minus 50,000 into 0.65 minus 3 lakh divided by 15,000. And then we have the EPS of plan 2. EPS of plan 2 will be x minus 1,65,000 and 0.65 getting multiplied because tax rate is 35%. Is divided by 30,000. So we can simply solve it by cancelling it as 2. Then it is 0.65x minus 32,500 minus 3 lakh is equal to 0.65x minus 107,250. This is further divided by 2. So on solving it further, you can just do the cross multiplication. So 1.3x minus 32,500. So into 2 will be 65,000 equal to 0.65x minus 107,250. And on simplifying it, we get 0.65x is equal to 5,57,000 750. So we have 5,57,750 divided by 0.65, which is 858076 is the indifference point. 5 lakh, 8,58,076 is the indifference point that we are getting over here. We've got the indifference point, financial break-even point, which one has more risk? How? We need to indicate over what rate range if any of the plan is better than the other. This is what we can answer very easily. We have stated that plan 1 is having more risk. So EBIT greater than 8,58,076. If your EBIT is greater than 8,58,076, what will be the resultant answer? Can I say plan 1 is preferred, and if your EBIT is less than 8,58,076, plan 2 is preferred. Yeah. Why are we preferring the plan 1? Because we are looking at a risky plan, and this is going to be a less risky plan. Lesser EBIT level will be generally used for lesser risky plan. Okay. Now, the next part of the question says, if a firm is fairly certain that EBIT will be 12,50,000, which plan would you recommend? Tell me, guys. If the anticipated EBIT level is 12,50,000, if the anticipated EBIT level is 12,50,000, EBIT expected is 12,50,000. The EBIT expected is 12,50,000. Then what do you say? Which plan would be preferred? One or two? Which plan would you prefer? One or two? Well, like 50,000. Okay, perfect. It's going to be plan 1 because it is above the indifference point. Since it is above the indifference point, plan 1 is going to be preferred. That's going to be the highest, providing EPS. That would be the likely higher level of EPS would be possible. Perfect. Now the last part which we have left out is I determine two EBIT EPS coordinates for each financial plan. Now what do you mean by EBIT EPS coordinates? Just need to prepare a table, right? We've got the EBIT. From that, we'll calculate the EPS. In fact, we need not prepare the entire statement also. You can say at EBIT equal to 8,58,076. EPS of plan 1 will be X minus 8,58,076 minus 50,000 into 0.65 minus 3 lakh divided by 15,000. Right? So if we do that, 8,58,076 minus 50,000 into 0.65 minus 3 lakh divided by 15,000. That comes out to be 15.06, 15.01, sorry. And same way, if we do it for the second plan, is 8,58,076 minus just 1,65,000 into 0.65 divided by 30,000. There also we know it is 15.01. So one of the coordinates is 8,58,076. Against that you have 15.01 as the coordinate. Same way you can get for EBIT of we've got the indifference points, right? Sorry, the break-even point. 5,11,538 EPS of plan one will be, it's a break-even point, so it's going to be 0, and EPS of plan 2 is also going to be. Okay. So these are simply the two EBIT and EPS coordinates that we are talking of. 8,58,076, against which you have the EPS, and against this you have these two. Right? So that's the coordinates that we were talking of. So tell me, guys, is there any sort of queries that you have? Can look at it, or else we call it a day. Any queries? How to go for good marks? Santosh Das is asking how to go for good marks. Well, good marks can be obtained just by study, nothing else. You need to remember the formula, you need to apply it appropriately. Yep. Are there any queries? No. The first part of plan that we have done, first part of the indifference point that we have done, or the first, in fact, capital structure theory as such, we are going to take it forward to the next level also. So next class will be dedicated towards the capital structure theory part. Will you upload these notes? Yes, definitely I will. Will upload these questions, PDF on the portal. Okay. Question and answer update. Which question and answer you are talking of, Vishwajit? Good. Fine. So we can call it a day. So let's just stop here for the day. See you in the next class, guys. Bye bye and take care.